Hey there, and welcome to this explainer. If you're looking to cut through the noise and get straight to the bottom line of what a company is actually worth, well, you are absolutely in the right place. Today, we're putting on our sell-side equity analyst hats. We are diving deep into the latest Q1 2026 filings to perform a rigorous, fully documented stock valuation of International Bankshares Corporation, trading under the ticker IBOC. We're going to strip away the fluff and discover the actual business reality together, strictly by the numbers.
Okay, let's dive into this. Here is our analyst roadmap for today. We'll start with their business model and edge, move right through their financials and concentration risks, and then we'll finish up by building our cost of equity and cash flow models to reach our final DCF verdict.
Section 1. Business Model and Edge. The Texas-Mexico Border Advantage. So IBOC operates 165 facilities and 247 ATMs, mostly across Texas and Oklahoma. But their real edge? It's capturing cross-border trade along the U.S.-Mexico border. To really understand how they run this massive network, we have to look at management's philosophy. Right on page 2 of the Q1 earnings release, CEO Dennis E. Nixon stated, "We are pleased with the consistency and sustainability of our industry-leading financial results in the first quarter of 2026. Notice those words, consistency and sustainability. Management heavily prioritizes conservative, stable balance sheet management over aggressive, high-risk growth."
Now you might be wondering, is management's talk of consistency just PR spin? Well, look at this timeline based on data from Macro Trends. IBOC was founded way back in 1966. By 1999, they initiated a consistent dividend payout program. And here, in 2026, they've reached a remarkable 27 straight years of dividend history, currently sitting at a yield of about 2.04%. That right there proves their conservative approach isn't just a talking point. It's backed by literally decades of actual performance and shareholder returns.
Moving on to Section 2, Financials and Peer Landscape. We're looking at the bull case here, specifically a massive capital buffer.
All right, pulling these numbers directly from the consolidated income statement on page 4 of their Q1 filings, look at these figures. Net income hit $102.2 million, which is up 5.5% year over year. Total assets grew to $16.83 billion, net loans are up to $9.5 billion, and deposits increased to $12.62 billion. The real so what here is that this growth wasn't an accident. IBOC actively managed their deposit rates, successfully lowering their interest expense. That strategic liability management is exactly what drove that 5.5% net income growth and helped them achieve a stellar net margin of over 39%.
But listen, if there is only one number you take away from the bull case today, make it this one, 23.15. That is IBOC's CET1 capital ratio percentage as of March 31, 2026, plainly noted on page 12 of the filing. Guys, this number is absolutely massive. It serves as IBOC's primary shock absorber against literally any economic cycle, far exceeding Basel III regulatory minimums. It's the ultimate defensive buffer that proves they prioritize long-term solvency over chasing short-term yields.
All right, Section 3, the CRE concentration risk. This is the bear case, where we really start exposing the loan book.
Now, what's really interesting about this slide is what happens when we lift the hood on that $9.5 billion loan portfolio. We find some serious concentration risk. A full 66% of IBOC's loans are tied up in commercial real estate, or CRE. Digging into the loan composition notes on page 18, they have a combined $1.9 billion exposure specifically to the multifamily and construction segments. In a high-interest rate environment with shifting vacancy trends, that level of concentration in commercial real estate is a pretty significant vulnerability. And honestly, that vulnerability, it's already starting to show up in the data. This figure right here, $160 million, represents IBOC's non-accrual loans at the end of Q1 2026. What's concerning isn't just the size of the number, but the trajectory. That is a 14% quarter-over-quarter rise from year-end. When you see a double-digit percentage jump in non-accrual loans in a single quarter, that is a glaring signal of early-stage credit stress within that heavily concentrated portfolio.
Digging into the investment securities footnotes, we find a few more friction points constraining their balance sheet flexibility. First, there's $159 million in doubtful commercial loans actively under internal evaluation. Second, and this is absolutely crucial, they have $354 million in gross unrealized losses sitting right in their available-for-sale securities portfolio. While these are mostly high-quality mortgage-backed securities, these paper losses restrict the bank's ability to opportunistically sell assets and reallocate capital. Finally, their biggest geographic advantage is also a risk. They have a high sensitivity to U.S.-Mexico trade relations and currency fluctuations. Which brings us to Section 4, Cost of Equity Assumptions, setting the rules of the game.
Okay, time to build our model. Now, since IBOC is a bank, we absolutely cannot use a standard free cash flow to the firm model. Instead, we use a free cash flow to equity, or FCFE, model. Let's briefly define why we do this. Cost of equity is the return a firm theoretically pays to its equity investors. For non-financial companies, you'd usually calculate the weighted average cost of capital, or WACC. But for banks, deposits, which are technically debt, are the actual raw material they use to create their product, which is loans. Because debt is an operational input and not just a funding source, we value the cash flows left over specifically for equity holders, and we discount it using the cost of equity.
Let's actually show our work here and explicitly declare our assumptions to calculate that cost of equity using the capital asset pricing model. For the risk-free rate, we assume an external input of 4.5% based on current long-term government bond yields. For beta, market beat data profiles IBOC at a very low 0.69, which makes total sense given their massive capital buffer and conservative history. We'll use a standard, sensible equity risk premium of 5.5%. Doing the math, 4.5% plus the product of 0.69 and 5.5% gives us a calculated cost of equity of 8.3%. So that 8.3%, that is the hurdle rate we're going to use to discount our future cash flows.
Section 5. Deriving free cash flow, bridging net income to FCFE.
So the crucial point here is how we actually translate reported accounting profits into real distributable cash. We start with the $102.2 million Q1 net income pulled straight from the SEC filings. If we annualize that as our base run rate, we get $408.8 million. However, IBO can't just distribute all of that. They need to retain capital to maintain that massive 23.15% CET1 ratio as their asset base grows over time. We estimate that equity reinvestment requirement at roughly $108.8 million. Subtracting that from net income leaves us with a clean, baseline estimated free cash flow to equity of exactly $300 million.
Finally, Section 6, DCF valuation and verdict. What is IBOC really worth? We have our discount rate and we have our baseline cash flow. Let's move to the next step and see how this all builds together through our three-step valuation calculation. Step 1, we forecast that $300 million FCFE completely flat for the next 5 years. Why zero growth? Because the rising non-accrual loans and the heavy CRE concentration headwinds absolutely demand a conservative projection here. Step 2, we calculate the terminal value assuming a sensible standard 2.5% long-term GDP-aligned growth rate. Step 3, we discount both the 5-year cash flows and the terminal value back to present value using our 8.3% cost of equity. When you run this math, you arrive at a total intrinsic equity value for the company of roughly $4.74 billion.
So if we take that $4.74 billion and divide it by IBEC's roughly 62.2 million outstanding shares, here is our verdict. On the left side of your screen, the current market price is hovering right around $73.26. On the right, our fundamental, mathematically derived intrinsic value is $76.27. This represents a modest upside. It is worth noting, though, that our model is slightly more conservative than the broader analyst consensus average of $85 reported by MarketBeat, and that's largely because we heavily weighted those CRE risks in our flat growth forecast. Ultimately, this entire valuation thesis for international bank shares rests on a pretty massive tension. They have one of the most conservative, incredibly well-capitalized balance sheets in the entire regional banking sector, but it's paired directly against a highly concentrated vulnerable loan portfolio. Which leads us to the ultimate question you have to answer for yourself. Will IBOC's massive 23.15% capital buffer be enough to absorb the coming tremors in their heavily concentrated commercial real estate portfolio? Thank you so much for walking through this explainer with me.